Now, with stocks gaining today, concern over energy costs have slipped just a little bit into the background. But prices for oil and other commodities, they are up for the year, and some see inflation as a major threat, accelerated inflation. Now, let's look ahead for the economy with my next guest. Tad Rivelle is the Chief Investment Officer at TCW Investment Management. His TCW Total Return Bond Fund has managed to outperform 99% of its peers over the last 5 years, and it is a Bloomberg Best mutual fund. Tad Rivelle, good to have you with us on Bloomberg. Tell us about inflation, headline inflation, core inflation. Does it matter? Should we make the distinction between food and energy and everything else?
Well, we should certainly make a distinction between food and energy and everything else. I think that if you look at the headline number of inflation, it looks very well contained, somewhere around 1%. If you X out the shelter component, the housing component, it's actually about 1.6%. Still a low number, but certainly not so low that the Federal Reserve, I think, can take its eye off the ball and not be concerned about inflation, particularly against a backdrop of QE2, the run-up in commodity prices, and the concerns that we're seeing in the Treasury market as it relates to the steepness of the yield curve and the overall rise in Treasury levels that we've seen over the last 4 to 5 months.
Tad, are you seeing any wage inflation? If they don't see any increase in the amount of money that people are making, is that going to not be a problem for the economy? Because oil, food, they seem to be more volatile, and they could change based on what happens in the Middle East.
Well, you're right. The wage inflation component thus far has been very moderated. It is our expectation that it will probably be rising over the course of the next 12 to 24 months. And I think that in discussing food and energy, it's also important to put it in a global context. And the global context actually cannot be disaggregated from the specifics of U.S. monetary policy. And what I'm referring to, of course, is the fact that a zero rate structure inside the United States has caused an export of a considerable amount of capital.
All right, we're going to continue the conversation more with Tad Rivelle from TCW. Tad Rivelle, we were talking about wage inflation and not seeing any increase in wages. And you're saying, well, maybe that is not, that's accurate, but that might not be the whole picture when it comes to looking at inflation.
That's exactly right, is that obviously food and energy costs are a very significant part of the homeowner's overall consumption bill, and it's obviously a lot larger piece of the overall financial equation when you look overseas in economies and in countries where people's overall incomes are quite a bit lower. The run-up in food and energy prices, we believe, is actually very directly related to the continuation of a zero-rate interest policy on behalf of the Federal Reserve inside the United States, because one of the consequences of running a zero-rate policy in the U.S. is that a lot of capital is fleeing in pursuit of higher yields. And to the extent to which it's going to, for instance, a country like Brazil, but not exclusively that, it allows or creates a dynamic in which the consumers in that country are experiencing an investment-driven boom. Their economy is growing very nicely, and it allows the consuming public in those countries to, in effect, bid up the price of oil and grain and other commodities around the world. And maybe in a note of irony is that to the extent to which there are certain countries that are the beneficiaries of this flight of capital, if that's the correct term for it, out of the U.S., their prospects are being accreted and they're more prosperous. In other countries, the situation is, so to speak, relatively worse, maybe in a place like Tunisia, for example. So to a certain extent, it's possible that part of the geopolitical turmoil that we're experiencing is actually made in America, in the sense that it's causing grievances in other parts of the world to be exacerbated by virtue of the fact that the populations in certain countries are not keeping up with the Brazils and other emerging market boom countries.
Tad Rivelle, do you believe that there's a concerted effort on the part of government officials in the United States to lower the value of the dollar? I mean, that would have the consequence of basically devaluing the debt that is outstanding, and it would, as you just described, drive up the price of some commodities. But at least in food, the United States is almost self-sufficient when it comes to food.
It's true. I mean, if you look at, first of all, if you look at the auction rate market, it's not necessarily just commodities. You could look at how the dollar is doing against some traditional stores of wealth, such as the Swiss franc. You can look at the shape of the Treasury yield curve and its steepness. You can look at the increase in implied inflation rates that are embedded in the TIPS market, the Treasury inflation protected securities market. All of those markets are indicating, or perhaps ratifying, or acknowledging the fact that the Federal Reserve has engaged in a constellation of policies, some of which surrounds zero rate, some of which is involved or embedded with the QE and QE2 that are pro-inflationary. And I think it is interesting to note that 6 months ago, there was a lot more discussion about where is the U.S. economy going? Are we going to deflation? Are we going to inflation? And I think that in large measure, because of the pro-inflation policies on the part of the Federal Reserve, that I think we're beginning to see an emerging consensus that actually the risks are beginning to become more skewed in the direction of higher inflation.
Ted, turn your attention now to the municipal markets. You're joining us from Los Angeles. Start with California. There have been notable examples of commentators such as Meredith Whitney, as well as Nouriel Roubini, chiming in and offering their very gloomy prospect for the municipal market, talking about defaults. What's your take on it?
Municipal finances obviously are very strained, but the notion that they are so strained that we're going to see wide-scale bankruptcies and defaults, we think is very improbable. We think that most of the fears in connection with the municipal bond market are very overblown, and I'll put it into evidence, so to speak, a couple of interesting numbers or statistics. Is that, first of all, if you collectively add up the expected budgetary deficits of the 50 states, it's a big number. It's about $150 billion. But then when you put that $150 billion in the context of a $14 trillion U.S. economy, you walk away recognizing that the shortfalls that we're talking about are about 1% of U.S. GDP. They're significant, but they're manageable. If you look at the stock of debt on behalf of the 50 states and include the debt issued by state agencies, well, it's about $1 trillion. Obviously, a lot of zeros. It's a very big number also. But that's about 7% of GDP, and it's only about 1/10 of the total size of the U.S. national debt in consideration of at least the public portion of it. So, again, we're not saying that the outlook for municipal governments is rosy, but they do have flexibility with respect to tax policy, and they do have some flexibility with respect to containing their costs. We think that, for the most part, they're going to work their way through this over the course of the next couple of years.
Ted, with the issues facing municipal governments notwithstanding, are you finding some values in the municipal bond market? Are people getting paid enough to take the risk?
Well, you alluded a few moments ago to the fact that we're out in California, and in actuality, two of the state governments that are perceived to be under a very elevated level of stress are, in fact, California and Illinois. And we do perceive the unsecured debt obligations of both of these state governments as being actually fairly interesting and attractive. In the case of both California and Illinois, the debt can be bought in both the traditional tax-exempt format as well as the taxable format, the so-called Build America Bond program, the federal subsidized program that facilitated the issuance of municipal debt on behalf of state and local governments that sunset on December 31. And some of the yield levels, we think, are actually very appealing.
All right, we've got to leave it there. Tad Rivelle, TCW Investment Company, thank you very much for your insights on muni debt and the economy.